Now, let me start the first afternoon session today. And the keynote speech will be by Professor Moritz Opstveld. So let me introduce him a little bit. Moritz Opstveld is a professor of economics at UCberkeley, and he also served in the Council of Economic Advisor under the Obama administration and as chief economist at the IMF. He's the co-author of two most famous leading textbooks in international economics, the undergraduate textbook, International Economics with Paul Krugman and Mark Melitz, and also Foundations of International Macroeconomics with Ken Rogoff. I've been using his textbooks for the past 20 years, so I'm a good fan of your books. And also, he's the author of more than 100 top research papers so far. And the topic that he's going to talk about is the most heated topic in the field of economics these days, the US dollar. So let me introduce Professor Opstveld, and let's welcome him with warm applause.
Well, thank you for that very kind introduction. I'm going to talk today about a paper that I wrote with a co-author, Haonan Zhou of Princeton University, for the Brookings Conference in September. And the paper was developed over many months, over nearly a year, but it comes at a critical time when the world economy is fighting with very high inflation, and many countries are dealing with the effects of a strong dollar. Economists have noted that the world economy is subject to synchronized cycles in asset prices, leverages, and capital flow, which they think of as a global financial cycle. One variable that is very prominently correlated with this cycle is the US dollar exchange rate. The dollar appreciates when global risk appetite falls, when there's a flight to safety or a panic in markets, when global financial conditions tighten, for example, tighter monetary policy by the Fed. But global financial conditions go beyond monetary policy of the U.S. Even when U.S. monetary policy is relatively tight, other financial conditions may not be as tight. To some extent, the global financial cycle really is a global dollar cycle. The factors which drive the financial cycle also drive the dollar, and the dollar has a global impact due to its unique global role. Of course, the dollar can be thought of in some sense as the world's currency because of its roles as a invoice currency, a funding currency, a vehicle currency, an anchor currency, and a reserve currency. Since the middle of 2021, we have been in a persistent appreciation phase of the dollar. I'll say more about this at the end. And right now, we're experiencing and expect an intensification of a slowdown in global activity as the Fed tightens, as other central banks tighten, and as the dollar appreciates. This paper is an attempt to understand more deeply what is going on by looking at recent models and recent empirical work. Just to give an overview of what we do in the paper, we begin by noting that this coming March will be the 50th anniversary of the final abandonment of the Bretton Woods system of fixed exchange rates and the adoption of floating rates by the industrial economies. Of course, the adoption of floating rates has gone much farther over these 5 decades to encompass many emerging markets. The strong dollar, however, is very strongly negatively correlated with global activity variables, and I'll document that. I'll then show some empirical estimates of the precise ways in which a stronger dollar affects emerging and developing economies. the ways in which it worsens macroeconomic aggregates, the terms of trade, and induces financial tightening in emerging markets. One key question that we try to address is what we call state dependency in the paper, but you can think of it as the nature of the policy regime. Do emerging markets do better when they don't peg their exchange rates? Do they do better when they have inflation targeting regimes, as Korea does? Do they do better when they avoid dollar denomination of external debt? We'll show that the answer to all of those questions is yes. But to understand how the dollar affects emerging and developing economies, we need to know what factors drive the dollar. Obviously, interest rates are important, but we also look in greater detail at the role of financial conditions beyond interest rates. One factor we find to be particularly important is the so-called excess bond premium measure developed by Gilchrist and Zarachek a decade ago. This variable turns out to be a very key predictor of U.S. recessions, and it also plays a large role in predicting events in emerging markets and in driving the dollar exchange rate. Finally, at the end, I will touch on the issues most closely connected with this conference's theme of international cooperation. What is the future of the dollar, and what perils does the current macroeconomic situation hold for the global economy if cooperation fails? Let me say a few words about exchange rate theories as they have evolved over the past 50 years, because understanding this evolution helps throw light on why economists now believe that the global financial cycle is so important. So these charts show data for the world, the high-income countries, and upper and lower middle-income and low-income countries on total capital flows and total current account imbalances. Let's just look at the world, just to be specific, and because we don't have unlimited time. But the green lines show total global current account surpluses and total deficits. In principle, these must be equal. In practice, they're not due to errors and omissions. And you can see that these have grown over time. Global imbalances have expanded. Generally, a current account imbalance must be financed. A current account surplus would involve net financial outflows as the country accumulates foreign assets, a deficit inflows as the country borrows abroad. If all countries access financial markets to the minimal amount needed to cover their current account balances, then total global financial inflows and outflows would simply coincide with total current account imbalances. But as you can see, looking at the blue lines and the red lines, the financial flows are much larger, sometimes an order of magnitude larger than what is needed to finance current accounts. In other words, there's a huge amount of two-way financial trade. This has expanded since the beginning of these graphs in 1980 over the entire floating exchange rate period, indicating that if we want to understand exchange rates today, we really have to look at financial factors, at least for understanding short and medium-term movements. Let me turn to the role of the dollar. And these two charts indicate the dollar's impact on growth in advanced economies and emerging markets. It graphs the nominal dollar effective exchange rate against growth in these two sets of economies. And you can see the very strong negative correlation between increases in the dollar, appreciation, and growth in advanced economies and emerging markets. The correlation is higher for the emerging economies than for the advanced economies, and it also rises over time. Now, in the paper, we present other regularities that we think are incredibly important in understanding the dollar's global role. For example, when the dollar strengthens, global commodity prices tend to fall in real terms. When the dollar strengthens, the growth of world trade volume declines. These correlations tend to imply that dollar strength is bad news for emerging and developing economies, particularly, indeed, for the world economy, but particularly for middle and lower income economies. Why are emerging markets particularly vulnerable to a strong dollar? Well, a number of factors have been isolated in the literature. For many countries, weaker institutions, including weaker, less reliable policy frameworks, weaker transmission of monetary policy through the markets, greater rigidities in markets, broader poverty, shallower and more distorted financial markets, a prevalence of dollar-denominated liabilities. This was dubbed original sin by Eichen, Green, and Hausman in 1999 in a famous paper. And while emerging market sovereigns have increasingly moved to denominate sovereign debts in domestic currencies rather than dollars or euros, corporates in the private sector borrow very heavily in key currencies, particularly in dollars. So they're vulnerable to an appreciation of the dollar, which raises the domestic value of their liabilities. There's also vulnerability to capital flow reversals. Agustin Carstens and Yun-Sung Shin at the BIS have called this phenomenon original sin redux. And it's the idea that when the US, say, raises interest rates, this will cause interest rates to rise in emerging markets. It will cause their currencies to depreciate. And so investors from industrial economies will have very strong incentives to pull money out of emerging economies when interest rates rise, say in the US or the Eurozone. And this is something we are seeing at the moment. Let me describe the estimations we do. I don't want to really go into the technicalities. So if you don't like equations, don't worry too much about this. But what our methodology seeks to do is to trace out the effect of shocks in the dollar on important variables in emerging markets. These include output, consumption, investment, government spending, exports and imports, inflation, the terms of trade, by which I mean the price of exports relative to the price of imports, bilateral exchange rates, and also financial market variables, including the stock market and the sovereign spread. Now, just to be clear on the exercise we're doing, the exchange rate shock we look at is the change in the overall index of the dollar's value against advanced currencies. And the reason we do that is because if we're looking at the effect on emerging markets, we want to exclude the possibility that we're actually looking at the effects of emerging market exchange rates. We want to look at something external to the emerging markets. But we do look at the effect of this broad dollar shock on each country's bilateral exchange rate, its own exchange rate against the dollar, which we think is a key variable. What do we find? Here I present a selection of the effects that we are looking at in our estimations. You can see here that on the horizontal axis we show where each variable is relative to its pre-shock level over time, over quarters. The shock is a 10% appreciation of the dollar index relative to other advanced economies. And you can see that the results are quite striking. We do this estimation on a panel of 26 emerging and developing economies to get the maximum amount of power. And let's start with the upper left-hand corner. An appreciation of the dollar index, the broad dollar index, causes a recession, clearly. You see GDP falling, and it actually falls for 8 quarters, for 2 years before reversing. As you would expect, private consumption also falls, which is the second chart in the top row. Government consumption falls, and we believe this reflects the fact that governments, when they come under the pressure of financial tightening, may need to restrict spending to improve the budgetary situation, to keep the trust of the capital markets and keep capital flowing and avoid a sudden stop in capital flows. We also see gross capital formation, investment falling. And I mentioned that a strong dollar is associated with a decline in the volume, the growth of world trade volume. And you can see here how real exports fall and real imports fall, although real imports fall by more. So there is a reversal in the current account deficit or a larger surplus. So this is a selection of the variables we look at. Let me turn to a few more. If we look at the GDP deflator, this falls, so we have deflation. Less of an effect on consumer prices. Last panel of the upper row, we see the exchange rate depreciates, and this is the local currency price of the dollar. So when that rises, that's a depreciation of domestic currency. Export prices fall. Import prices fall. These effects also last for about 2 years or 8 quarters. Export prices fall somewhat more than import prices, and so the terms of trade worsen, as the last box in the second row indicates. Let me turn to some financial variables, key financial variables. The local currency value of credit to the non-bank sector falls after a dollar shock. The stock market falls. The central bank tends to raise the policy interest rate, as we can see in the first box in the bottom row. And finally, the sovereign spread, that is the spread that the country pays on its external foreign currency borrowing, also rises. International capital markets view the country as being more risky. What can we say about the policy regime and how that matters? We looked at three different types of experiments in the paper. We looked at the exchange rate regime, whether the country has a strict peg or a tight falling peg versus a more managed flexibility or a float. We look at whether the country has a credible inflation targeting framework. And what I show on the left here is a comparison for pegs and floats. Floats are in red, pegs are in blue. And if we start with the first row, the left-hand chart, you can see that when there was a dollar shock, the negative effect on real GDP is much worse for pegged exchange rates. In fact, we don't see much at all for floats. They seem to some degree to cushion the economy. The terms of trade, moving to the second box in the top row, deteriorate more for a peg than for a float. Moving to the second row, at the left-hand slide, you can see that the equity market declines whether you have a peg or a float, but it declines more in the case of a peg. And finally, looking at the last box in the lower right-hand corner, it is mainly pegs that respond by raising their policy interest rates. They need to do so to maintain the peg in the face of a dollar shock. It is the case, however, that floats don't respond much at all in terms of tightening the policy interest rate. So what we learned is that pegs seem to do worse than floats in the face of dollar shocks. And I want to caution that we have to be careful in interpreting these data because countries don't randomly select to have pegs or floats. Countries may pick floats because of factors that also lead them to have better outcomes when the dollar strengthens. So that's an important caveat, but nonetheless, the contrast is rather striking. To understand these results, we need to understand the determinants of the dollar. What are the shocks that drive the dollar, and how do those shocks particularly affect emerging and developing economies? So we turn in the paper to an excursion into the recent theory of exchange rate determination. And that starts from a so-called interest parity condition, which we can see in this equation that I've highlighted on the slide. In this notation, I star is the treasury rate of interest in a foreign country, say the Eurozone. I is the treasury rate of interest on U.S. treasuries in dollars. S is the dollar exchange rate. It is the foreign currency price of the dollar, so that when S goes up, the dollar strengthens. And the left-hand side is the difference between the foreign treasury rate and the U.S. treasury rate, corrected for the expected movement in the exchange rate. Now, in a world where everyone is risk neutral and where arbitrage is perfect, the left-hand side would be zero. But in reality, it is not. And it can depend on a number of factors. One of these could be a risk premium or an excess return. Modern theories link this either to risk aversion, as in the capital asset pricing model, or possibly to financial frictions, which limit financial intermediation. There's also a factor which we call lambda superscript dollar, which measures the special role of the dollar as a liquid currency, which may make people more willing to hold dollar assets, even if these offer a lower rate of return on an exchange rate adjusted basis than other assets. And finally, gamma is the special liquidity advantage of U.S. Treasuries. The Treasury market is the deepest, it's the largest sovereign debt market. Treasuries play a unique role as reserves, as collateral. So gamma is meant to capture that advantage of the dollar. And we can solve this interest parity condition to derive an exchange rate equation, which relates the change in the dollar to changes in short-term interest rates, or alternatively, long-term interest rates and term premia, which are the risk premia embedded in the prices of long-term bonds. We also need to measure these liquidity factors, dollar liquidity, and the liquidity of treasuries. I'll say a little bit more about those on the next slide. And we also use as a measure of excess return this row variable in the top, the excess bond premium measure of Gilchrist and Zarachek that I mentioned before. Finally, we use the Chicago Board of Options Exchange VIX index, which is often called the fear index, and it's an index of volatility in the equity markets. So we look at the effects of all of these variables. I'm not going to go into great detail on the way we measure these things, because I think it's probably of less interest to this audience. But what I will say is that we build on a recent literature that focuses on so-called deviations from covered interest parity, a feature of markets that has become very important since the global financial crisis. Now, a very important component of the foreign exchange market is the forward exchange market, where individuals can sign contracts today to trade foreign currencies on a future date at a pre-agreed exchange rate. Given the existence of that market, I, as an investor, could face the choice between investing my money in dollars or investing them in euros and selling those euros forward for dollars in the forward exchange market. Covered interest parity, which held pretty well up until the global financial crisis, says that the return from those two investments must be identical. Since the global financial crisis, the returns have not been identical. In fact, the gap between them, the so-called cross-currency basis, expands in periods of stress. And so it can serve as an excellent indicator of stresses in the foreign exchange markets that might affect exchange rates. However, another strand of the literature indicates that dollar appreciation itself may lead to bigger movements in this deviation from covered interest parity by tightening financial conditions and reducing the balance sheet capacity of intermediaries. So when we look at the effects on the exchange rate, or what I loosely call the effects, we have to be clear that we're looking at correlations, not structural relationships. Nonetheless, I think we learned quite a bit from the exercise. We learned that both short and long-term Interest differentials appreciate the dollar. So when dollar interest rates at short or long-term rise relative to foreign countries, the dollar strengthens. Treasury liquidity strengthens the dollar. Excess bond premium of Gilchrist and Sarachek is associated with dollar strength. So when lenders to American corporations become more reluctant to lend, when their risk appetite declines, the dollar tends to strengthen. This is a very consistent and strong correlation. We find that our exchange rate equations have a considerably stronger in-sample fit than you might expect, and especially after the global financial crisis. You can appreciate that explaining the movements in exchange rates is hard, just as explaining the movements in stock prices is hard, even with contemporaneous data. Given the importance of this Gilchrist and Sarachek excess bond premium, we repeated our earlier exercise to look at the effects on emerging market macro and financial variables. And what we find is that a tightening in this premium leads to a very deep and protracted fall in real GDP and investment, deep deflation, terms of trade deterioration, falls in equity prices that are very persistent, and a large increase in the policy rate of interest. So this driver of the dollar seems to be a particularly powerful negative force for emerging markets. So let me turn in the remaining time to the current situation in global markets, because we have been seeing strong increases in dollar interest rates, short and long term, the policy rate and the long term rate. We've been seeing strong dollar appreciation. We have not seen the domestic risk indicators for corporate lending in the U.S. rise by as much as they typically do in recessions, but that may be coming. But what do the data tell us? The left-hand chart here shows the path of inflation since the beginning of 2020, when we were still pre-pandemic. And you can see very clearly for emerging economies in red and advanced economies in blue, how inflation fell in the depths of the pandemic as the world basically locked down, but then how it rose with reopening, and then how around the middle of 2021, inflation began to sharply accelerate in both country groups. In the background, the dollar was moving, of course. It strengthened sharply in the panic of the spring of 2020 as the pandemic emerged, and you can see that here. Then as the Fed rolled out massive monetary stimulus, it fell, reaching a bottom in the middle of 2021. But long before the Fed started hiking interest rates in March of 2022, the dollar was already on the rise because it was obvious that the U.S. was recovering faster than the rest of the world, and the Fed would have to raise interest rates sooner than other industrial countries, which indeed was the case. Emerging markets, however, saw the problems coming and began hiking already in the middle of 2021, and this includes Korea, of course. This chart is a bit out of date because the tightening cycle has been proceeding apace. But what you can see is that very, very few advanced economies hiked on the left-hand side in 2021, shown in orange, compared with emerging markets. But there have been big hikes, shown in green, in 2022, and the hikes in the emerging markets have continued. The situation is one where there's a massive global impulse for tightening, which could set off a massive recession if it continues at the current pace. Inflation will come down, but inflation is partly driven by supply shocks, including the effect starting in February, March 2022 from the Ukraine war. But even before that war, food prices had been rising and energy prices had been rising very sharply. The war made things worse. Now, one danger in this scenario is that jointly, if there is no attempt to cooperate, the world central banks will create a worse recession than is actually needed to bring inflation back to target. When the Fed hikes its interest rates and other countries suffer depreciation of their currencies, that raises their import prices and worsens inflation. And this might lead them to hike interest rates even more. In effect, emerging and developing economies suffer both from the tightening of financial conditions and from importing inflation due to the dollar's strength. This is also true to some extent in the advanced economies, but emerging markets generally, because of their weaknesses, their fragilities, are much more vulnerable to the effects of financial tightening and the effects of domestic currency depreciation and higher interest rates. What is needed here, I think, is for central banks to communicate clearly with each other and to take even more account than they normally would of the actions of central banks abroad and of the reactions to their own policies. Another measure that could be very useful would be a greater extension of swap lines to emerging markets. Emerging markets could intervene in the foreign exchange market, not just emerging markets. Japan has been doing this. But in doing so, they could use up precious reserves that they may need later. In that sense, the swap lines would be very, very useful. And Korea is a country that has benefited from these in the past, and especially benefited during the global financial crisis. And I'll wrap up. Korea has benefited quite a lot in the spring of 2020 and after. It benefited during the global financial crisis. And this is one way that international cooperation could help if richer countries would extend swap lines to a broader set of emerging markets than they have done in the past. Also, the position of the IMF is critical, and countries could help themselves by taking greater advantage of the liquidity facilities that the IMF has created, particularly as a result of the crisis. There are many other challenges ahead, and maybe we can discuss some of those in the balance of the session, but I will wrap up here for now.
Professor Opsfeld, let's give him big applause for his very, very important presentation. Some of his presentation might be a little hard for non-econ majors, and I hope that this can work as an incentive to learn economics and become econ majors, those who are logged in. We have two discussants for Professor Opsfeld's presentation. The first discussant is Dr. Shin-Young Park. She's the Director of Economic Research and Regional Cooperation Department at the Asian Development Bank. So let's welcome Dr. Park.
Thank you. Thank you, Professor Opsfeld, and thank you, Professor Kim, for giving me the opportunity to discuss this very interesting paper and presentation. I do hope to bring some light of Professor Opsfeld's presentation in the current context of Asia Pacific. I don't want to dwell on like what's happening because everybody's aware. In response to the inflation surge, the Fed has started to raise its policy rate, and then the pace of Fed interest rate hike have become much faster. At this current pace, the U.S. interest rate may actually surpass those of both developed and then developing countries. The dollar, as a result of that, reached historic highs many against the many Asian currencies. The dollar strength could also feed into prevailing the depreciation expectation. It could also bring the imported inflation that causes a lot of problems for Asian development. Asian central banks. During the period of market volatility, what we also see, as the Professor Opsfelder would also kind of indirectly mention, unwinding of carry trades that could exacerbate the dollar, the currency depreciation in the local currencies, of course, the dollar strength even further. And capital flows to emerging and developing countries in Asia will likely reverse. What we see is already reversed. And that also elevates the financial risks. Across the region, you see the inflation already picking up. Quite a few Southeast Asian economies, including Philippines, Singapore, and Thailand, also East Asia, Korea, have already experienced quite a significant pickup in inflation. The Fed rate hikes have already led to significant currency depreciations across the region, and it also instigated the net portfolio outflows from the region. And in the 2022, you actually see that the currency and the capital outflows are quite significant already. In response, many Asian central banks also started to raise interest rates to curb inflation and safeguard macro financial stability. In fact, in the region, especially in Central Asia, the Kazakhstan, Kyrgyz, those economies that were experiencing very high inflation earlier already started to raise the interest rate in in the beginning of the 2021, and now in East and the Southeast Asia, Philippines, Malaysia, Korea actually started also in mid 2021, but then now quite a bit of the Southeast Asian economies that you have seen a very high inflation rate also started to respond quickly. And what we see is, as Professor Opsfeld also, the really elegantly demonstrated, the foreign exchange rate depreciation correlate quite significantly with the interest rate differences. So when we look at the period of January 2022 and then August 2022, you can see cross country there are quite visible the correlation between the FX depreciation and interest rate differences. What does this all mean? Actually, like the Professor Opsfeld mentioned about the covered interest rate, but we also talk about a lot the uncovered interest rate parity. There's the theoretical the interest parity that any sort of interest rate differential should be met by the expected depreciation of the currency, but empirical regularity often tells otherwise. So there's kind of like a persistence of UIP, the uncovered interest rate parity premium, and many the economies that have brought the carry trade as a part of maybe the explanation. The carry trade is a trading sort of strategy technology to take advantage of the UIP deviations by borrowing low yielding currencies. The country where the interest rates are kind of low, but then invest in the higher yielding currency. We've seen this carry trade a lot in East Asia, and Korea has been always a bit of a victim or the country that attracts the large amount of the carry trade investment. And as the volume, like the theoretically, and then also the economists would argue that the volume of the carry trade is large enough, then the arbitrage opportunity will disappear, and then UIP condition should actually hold. Of course, in practice, it doesn't really happen. And then people also often mention that these FX speculation may not really happen frequently. Like a portfolio positions of the investors do not really change frequently enough, or like the it doesn't really happen in a large amount. Both because markets are not as efficient as we hope to believe, or the investors are not really risk neutral. Investors tend to be more risk averse. So there's a kind of expectation. There's the compensation for investors taking risk, so risk premium. Now, that all relate to that. There's might be like a transaction cost, market frictions, and that really deter adequate carry trades from happening. And then the UIP condition will kind of persist. So this, I don't want to bore people even further by introducing any equation. This is, but it's actually very, very simple equation. I hope it's not, it doesn't really bore people. It's the UIP premium, basically. It's the sum of the interest rate differential and then the exchange rate adjustment, as I mentioned. I want to just look at quickly the like the dynamics of the UIP premium over time, how it has changed in Asia, and then also the advanced economies. What's interesting is the bottom two charts, the emerging economies, where you can see the the yellow circle in earlier in the period, like in late 2000, late 1990s, and then 2000, early 2000 up to mid 2000, you can see that the UIP premium tend to correlate more with the interest rate differential. So interest rate differential is the one pulling the explaining a lot of these UIP premiums, and then it sort of resolves it. But then in the later period, later in 2015 and then 2020, it's getting a little more correlated with the exchange rate adjustment. Might also because of more flexibility in the currency market. Many countries are moving also towards even more a flexible exchange rates, and that behavior is quite similar actually to the dynamics in advanced economies. Advanced economies, the overall the UIP premium has been more correlated with the exchange rate adjustment rather than the interest rate differences. So this again, like in advanced economies, the UIP premium, you can see that also it fluctuates around. If I show that chart again, a bit closer to the zero. Now the patterns in the emerging market economy, UIP premiums were much greater. Now it's actually being a little lessened. And then correlation patterns are getting a bit closer to the developing countries. This is the same thing with the ruling correlation. I don't want to go into that again. But why is there this kind of changes? The deviation from the UIP condition, does it actually decrease as the capital markets develop? We want to actually explore a little bit more on that, and then we are actually doing a study, but the UIP condition does not really hold in emerging market economies. What we see is that over time the UIP premium does decline, and we do see some correlation with the development of the local currency bond markets. So the local currency bond markets are, they were developed as to mitigate the financial vulnerability by, a lot of Asian economies. But the local currency denominated debts can trigger unwinding of the carry trade. This is what also Professor Opsfeld mentioned about the original sin redux. What's interesting is that local currency bond market may actually help reduce the UIP premium, but in times of the financial volatility, it could actually even trigger the unwinding of carry trade, and then it accelerates the depreciation expectation, which makes the the emerging market economies and the currencies more even vulnerable to capital outflows. I want to show you one thing that really represent the weaknesses of Asian financial system. Asian financial system, despite the efforts, the Asian investors actually invest in assets in dollar-denominated assets, and then they are. A lot of liabilities are now held in the local currency denominated, but it could actually make the Asian financial assets or financial markets vulnerable or exposed to unwinding or carry trade, like original sin redux. So at the end, let me just give some summaries, and then also the policy implication. Financial cycle when the financial cycle turns, it can actually hurt the emerging market borrowers. It could trigger capital flight, and then pose the risk to financial stability. During the periods of the financial distress arising from high U.S. dollar funding costs, as Professor Opsfeld also mentioned, many non-U.S. global banks may be forced to curtail lending to emerging market economy. That is really part of the original sin redux story. And the regions of policymakers should remain vigilant against the financial turmoil. And lastly, so this is why we are all here. Why is the financial cooperation important for the region? Development of the local currency bond market is one initiative, very important initiative by the ASEAN+3 economies during in the aftermath of the Asian financial crisis. It should still continue, and we should actually promote the more faster the development and then of the local institutional investor that could really invest in the local currency assets, rather than still invest in dollar assets. And the policy coordination is important. As Professor Opsfeld also mentioned, that the region does have the regional financial safety nets. With the Chiang Mai Initiative, multilateralization, CMIM, and then the EMRO, which work as the independent regional surveillance unit. Chiang Mai Initiative has a capacity of dollar funding at $240 to $40 billion US dollars. Still very, very small compared to the total size of the Asian financial system, the capital markets. We still need to strengthen and then improve the function and the capacity of the CMIM, and then also really building the capacity of EMRO to act more capable the regional financial surveillance agency. Thank you.
Thank you very much, Dr. Park, for great Asian perspective on financial cooperation among countries. We'll move directly to the next discussant, Professor Seokjun Kwon. He's from the Chemical Engineering Department at 성균관 University, so it doesn't seem to be directly related to the topic of the afternoon session, but he's an expert in global supply chain, especially in semiconductor industry. So he can provide us industry view or more practical view on U.S.-China trade war in this most important area, semiconductor industry these days.
Thank you for the introduction, Professor Kim. And my name is Seokjun Kwon from School of Chemical Engineering at SKKU. And it is a great honor to be here to present about the cooperation focusing on the techno-economic aspect about the global economy. As many of you already know about the global economy, since the last 70s or 80s, the global economy has been as heavily depending on the economic growth based on the techno-economic innovation, such as the semiconductor industry or the automobile industry. And I would like to say that the semiconductor industry is one of the powerful growth engine for the global economy. But many of you knows that that the global economy at the crisis because of some techno economic the conflict between the U.S. and China, focusing on the semiconductor industry. So, in this discussion, I would like to talk about the why this kind of the techno economic crisis occurs and what will be happening after the breaking of the cooperation. So it is well known that in the semiconductor industry that the gravity of the industry of the semiconductor industry has been shifted from the U.S. to Japan and the South Korea and the Taiwan. And nowadays we have been witnessing that the gravity is based on the East Asia, such as South Korea, Taiwan, and China and Japan. And in particular, we have witnessed that there is some growth in the China's industries because of the heavy investment from the central government and the state government. And it means that the global sales occupation given by the China will surpass the U.S. as well as the Taiwan or South Korea. And in particular, since in last 2010s, there is some very large semiconductor industry clusters all of the mainland China, and this clusters is one of the powerful engines for the China semiconductor clusters. And we have also witnessed that there is some notable point such as a hierarchy in the industry in the China's from the design to fabrication, from fabless industry to foundries in the mainland China. It means that the ecosystem of the industry focusing on the semiconductor in the China is very large, and it will occupy actually on half of the global the industry. And there are driving forces for this growth in the China's semiconductor industry, such as China's 5-year plans. And there is some accumulated investment for the 13th 5-year plan, such as $20 billion given by the government and $100 billion from the private sectors. Actually, the government support, such as there's some economic subsidies, whereas tax exemptions, fundraisings, or long-term investment in the SOC, and this investment given by the mainland, the main or central government, is the driving force for the China's industries. And I'd like to talk about what will happen next. So we can say that there will be kept growth in the China's semiconductor industry. For example, we can talk about more than 50% of global demand will be from mainland China up to 2025. It means that there will be amount of $200 or $300 billion in terms of the global sales. And there will be the most of the industry factors such as design sales, whereas the offset or foundries or the chip designs. The Chinese occupation will surpass about at least 25%. Or the 30% or 40%. And based on this, we can say that the most of the semiconductor industry ecosystem will be focused on the Chinese growth. But there's some crisis in the global corporations because the global corporation in the semiconductor have been the most powerful engines for all of the key players in the global semiconductor industry, but there are some pitfalls facing the China's growth, such as we can talk about the interior factors such as low efficiency or low stability or low revenue on investment, and there is the rapid growth of the number of closed companies such as the bad companies on the semiconductor fabless company or foundry companies. And we need to also talk about that there is some duplicated investment, and it means that there will be a risk of bubbles. And we need to also talk about the exterior factors for the pitfalls. There is some statecraft between the U.S. and China. It means that there is long-term policy of the U.S. on the reorganization or restructuring of the global value chain of the semiconductor industry. It means that there will be sanctions, the expansion of the technology gap between the U.S. and China, and the U.S. is focusing on making the gap increase on the foundry aspect or GPU or DRAM. And this pinpoint ban policy driven by the U.S. government is deviation of the global standard of the China's semiconductor industry. And it means that there will be a great deal of cost rises such as heavy independence of the import or low self-sufficiency of the China's industries on the global supplies. So there will be facilities or materials or devices or products in the most aspects of the global semiconductor industry will suffering a great deal of cost increases. It means that there will be decrease in the economic efficiencies. So there will be a future direction, such as a diversion in the future tech. It means that there will be 2 or 3 directions for the next generation semiconductor technologies, and it means that there will be no cooperation between the key players in the semiconductor industries. So the China's rises in the semiconductor industry is doomed in terms of there will be some details on the techno-economic sanctions of the U.S. on China's semiconductor industry. So, for example, we can talk about the prohibition of importing somewhat advanced semiconductor facilities such as EUV lithography or technical IVs or DUV lithography or the graphical processing unit imported by the AMD or NVIDIA in these years. And the reorganization of the global value chain in semiconductor industry, we need to talk about that there is some recent trend in the reorganization of the semiconductor industry, such as a big M&A among hardware or software application or software companies. And this big M&A mean the changes in the global industry and the global supply chain, there will be cost spike. And there will be the formation of economic or techno-political blocks such as IPEF, PERT, or AUKUS or Chip Alliance. And this means that there will be protectionism such as reshoring. We can talk about the Chip America rules or IRA or friendshoring trend. And this also will result in the regional uncertainties such as in Russia-Ukraine war, or there's some conflict between the mainland China or Chinese Taiwan. And there will be global crises such as the climate crisis. And the most of the large industry in the semiconductor industry will suffer some uncertainties given by the R100 or requirement for the carbon neutralities. So in terms of the global value chain in semiconductor industry, we need to talk about the global value chain in the semiconductor industry, focusing on the East Asia's. For example, we can talk about Taiwan and South Korea in aspect of the foundries. So the 85 or 9% of the foundries are focusing on the South Korea's Samsung Electronics and the Taiwan's TSMC. And in terms of the design IP, such as EDA, and we need to talk about the most of the design IP are focused on the US. And in terms of the fab equipment, the US, Japan, and the Netherlands will occupying the most of the global sales. And in terms of the memory chips, the South Korea, US, Japan, and China occupy the most of the global market. So it means that there are very few players in the global semiconductor industry, and the reorganization of the global value chain means that there will be a large or the cost spike in this global industry aspect. For example, we can talk about as of 2020, the global trade of semiconductor chips is about $1.7 trillion, but there will be the decrease in the global semiconductor chip prices about the 20% or 25%. This is because of the techno-economic crisis between the U.S. and China. But in terms of the trade network between the U.S. and China, there is intermediate key players such as Taiwan, South Korea, Japan, as well as EU, then the Southeast Asia. And it should be noted that there are heavier independence on the China rather than the U.S. for these key players. For example, we can talk about the Taiwan or South Korea and Japan, which are the members of the Triple Alliance, which is planned in the near future. And you can see that there is about $117 billion between the China and Taiwan, and $81 billion between the South Korea. But in terms of the U.S. network, the Taiwan U.S. network is about just $8 billion, and the South Korea, the U.S. network is just about the $6 billion. It means that there are heavy heavier dependencies of Taiwan or South Korea and Japan on semiconductor value chain with China rather than the US. It means that there will be large increase in cost for all players if there is a reorganization driven by the formation. It means that there will be the breakage in the global cooperation in the semiconductor industries. And in particular, South Korea and Taiwan will suffer the most of the severe cost spikes. So we can talk about there will be worldwide semiconductor trades decrease from the $1.7 trillion to $1.4 trillion. And there will be additional cost rises from the $170 billion to $250 billion yearly for the China. And most of the key players involving US, South Korea, and Taiwan will suffer the severe cost spikes. And this will bring us the impact and the sequences, such as reorganization of global value chain of semiconductor industry, which will result in the spike in overall cost, and this will increase in the prices of all of the chips. And it means that there will be hurt in the IT-driven innovation, such as we can expect there will be some cost increases in the artificial intelligence or data-driven industry or deep tech industries. And it means that the economic growth in focusing on this IT-driven innovation will be slowed down. And it means that there will be recession and given by this slowed down growth. So I can talk about what is the long-term aftermath of the reorganization of the global value chain after the breakage of the global cooperation. The first scenario is just the China will pursue its independence in the semiconductor technology by developing its own industrial ecosystem or supply chain. But in this scenario, China will suffer some kind of the technological diversion, and it means that there will be a great deal of losses in the techno-economic advances for the China. And in the second scenario, the US-China will reconcile to recover the global value chain. It means that the recovery of the global cooperation in the semiconductor industry. But there will be some cost surge in the global semiconductor market before the reconstruction of the global value chain. And in the last scenario, there will be some fall of China in industry, semiconductor industry. It means that there will be some kind of the submission of the China to the US. US-driven the sanctions. And nobody knows what will happen exactly in next 5 or 10 years, but in this range of the scenarios we can talk about and we can prepare the impact given by the global value chain reorganization. And I will skip this. And we can find out what is the positive impact given by the global corporations in the semiconductor industry. I can talk about the exemplary cases about the Netherlands, which has very strong cooperation basement for the European semiconductor industry. The Netherlands-based industry or Netherlands-based companies such as ASML or ASME has been cooperating with the European companies such as JICE or the other companies to make the economic innovations and the economic losses. And we can take some lessons from the Netherlands, such as the formation of a strong cooperation, such as university-wide or industry-wide or nationwide, the collaboration clusters over the countries and over the centuries for the deep tech formation. And these cases from the Netherlands is industrial cooperation or cluster formation. It means that the division of labors or division of these industries based on the Netherlands industry, we can take some lessons from these cases to recover the global cooperation to reduce the cost. And we can also take some lessons from the next generation semiconductor technologies focusing on the global cooperation to reduce the overall cost and to enhance the global economic efficiencies. So let me just conclude my discussion that there will be some heavier impact given by the U.S. and China's techno-economic crisis and the conflict in nowadays. And this conflict will result in the overall decrease in efficiencies and the overall increase in the cost for the global semiconductor industry. And to recover the global cooperation in this semiconductor industry, we need to take some lessons from the the formation of the strong the cooperation network between the companies and between the nations. And the Korea's strategy to take this impact. It should be based on the open ecosystem and the intensive investment in research and development. And we need to join the next technology leading groups. Let me conclude. Let me stop this. Thank you.
Thank you very much, Professor Kwon. That's another very important aspect for cooperation by the national level or industry or even company level to overcome broken global supply chain due to focus on economic securities, which is happening all over the world right now. Let me go back to Professor Opsfeld's presentation. So he mentioned that the world is probably suffering from unnecessary recession because of the lack of cooperation by central banks. They're unnecessarily raise interest rates altogether without considering the spillover effects from their policy to other countries or repercussion effects on the other hand. So it's very important to note from his presentation that economic cooperation at this level is really important. Dr. Park provided Asian perspective of similar economic cooperation, especially among the Asian developing countries. So before I open up the questions and comments from to the floor, I have a couple questions to Professor Opsfeld. A lot of economists are starting to criticize U.S. Fed that they are, raising interest rate too fast and too much without considering the spillover effects to other emerging economies. So I would like to ask your opinion about U.S. Fed policy, if you agree with their pace of their interest rate hike these days. And also the second question is the last graph that you showed us, the interest rate policy or monetary policy of all the countries in the world. Japan and China are the only exceptions who are not acting at all, especially Japan still maintaining near zero interest rate. Do you think that might impact any stability in international financial markets? So those are the two questions to Professor Opsfeld.
Well, let me first thank Dr. Park and Professor Kwon for their excellent discussions, which were fascinating. I think one lesson from Dr. Park is the importance of developing a strong investor base for domestic local currency sovereign debt when it is held mostly by foreign investors. This can be very dangerous. So that's an important policy lesson. Professor Kwon's discussion may not seem to be related very much to the dollar, but I would come back to the point that the tensions between the U.S. and China, which have really been heightened most recently by the U.S. ban on semiconductor exports, really threaten the dollar system, which in some sense is a form of cooperation. I mean, having a global currency has many economic advantages, but when that currency gets caught up in great power rivalries, you may get fragmentation in the world economy and a breakdown of cooperation. So I think both of these discussions were very relevant. On the specific question about the Fed, I think it is important that the Fed actually succeed in getting inflation under control in the U.S. because the stability of the dollar is actually very important for the global economy. I think it is important that the Fed does not go too far. I don't think they have gone too far yet in the sense that the U.S. economy remains strong. But at a certain point, for example, after the next two hikes, it will be time to really begin to be much more careful and asked if an adequate message about inflation resolve has already been sent to the market. In other economies, I worry more about going too far. For example, Europe, the effects of dollar depreciation on inflation have been particularly strong. And also the extent to which the shock is a real supply shock that monetary policy really can't do anything about is greater in Europe and the US. I think somewhat fortunately, central banks are starting to look a bit more cautious. The Bank of Canada this week raised interest rates by 50 basis points rather than the expected 75. European Central Bank seems to be taking a more moderate view of what they will do in the future. They raised interest rates today by 75, but they seem to be looking more cautiously at the future, judging from their statements. I'm somewhat optimistic that a more measured and deliberate approach is going to prevail. And in fact, if you look at global inflation data, there is some evidence that global inflation may have reached a peak and is now starting to stabilize and turn down. So, I'm hoping that with not too many more interest rate hikes, the Fed will be able to have basically accomplished its mission. Hopefully that answers the question, or at least gives my answer to the question.
Yes, thank you very much. Second question was about Japan and China. Do you have anything to say about it?
If you look at G20 economies, actually the three that have been lowering interest rates are China, Russia, and Turkey, for very idiosyncratic reasons. And in fact, the Turkish situation with inflation running at about 80% year on year, and the president of the country set on cutting interest rates to correct that, is clearly on a path to total disaster. Russia and China are in very different situations. China is facing slow growth due to the lockdowns over COVID and due to a looming real estate crisis. So I think their reactions have been pretty appropriate. And Russia is having raised interest rates sharply at the beginning of the invasion of Ukraine, feels they have a little bit more room to lower them in the face of a domestic contraction. Japan, is an interesting case. They've finally gotten inflation to 2% and over after having tried to do so for about 10 years unsuccessfully. The fact that their interest rates have not risen is leading to an extreme depreciation of the yen. And that is, of course, causing problems for countries that compete with Japan, such as Korea. I don't see on domestic grounds a strong case for Japan to raise interest rates at the moment, even though this is causing some problems for trading competitors. If inflation were to go significantly higher, which I doubt it will, there would be more of a case. Now, of course, Japan has been trying to intervene to slow the depreciation of the yen. That has not been very successful to date. I'm afraid they're not going to be able to have it both ways, having very low interest rates and a stronger currency.
Okay, thank you very much. We have a couple minutes left before we close the session. Dr. Park, do you have anything to respond?
Well, I just want to reiterate that the economies in the region face really significant common financial risks. When dollar reaches a historic high, oftentimes the emerging market currencies do depreciate fast, and that could really instigate even greater depreciation expectation, which is very unfortunate. We do feel, but the region does have really vast, saving within the region, which should be much more actively, proactively managed for the region's, the investment demand. And one great, opportunity is to develop and deepen the region's financial market, especially, the fostering the local currency denominated debt. But just by issuing it, it's not going to be enough. We have to actually, foster also the local investors who will be able to to intermediate those regions' savings for regions' investment in local currencies. So that's one area that ADB has been also very active, and then we hope to see more continuation and also support from the regional economies. Another one, again, as I mentioned, that I don't really think it's really about the swaps with the U.S. Fed. It's not always very easy to expect, but having the like multiple layers of financial safety nets, including the those close connection coordination across the region's central banks, and also trying to actively coordinate the monetary policy, monetary responses to external shocks, and at the same time, how to use the the very precious foreign reserves more prudently, effectively for the region's financial stability will be very important. And CMIM is one good example, but it does need stronger the capacity in the local currency funding, and also really like a more effective operation. So I hope that the region does continue its financial cooperation. Thank you.
Thank you all for this wonderful session. This will conclude the third session today. Thank you.